Thank you for joining us and welcome to the Lazard Insights. Our presentation today features Jason Williams, Portfolio Manager on Lazard's Equity Advantage team. Please note the information and opinions discussed today do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll turn it over to you, Jason.
Hello, my name is Jason Williams and I'm a Portfolio Manager on the Lazard Advantage team. Today I'm going to talk about the pertinent considerations with regard to risk controls for investors interested in investing in quantitative equity products. Now, over the last few years, we've found that investors' focus has very much been on factor returns, whilst factor risk and portfolio construction has been relegated to more of an afterthought. Now, I can understand that. As a former colleague used to say, you can't eat risk for breakfast, right? However, we believe how you measure risk and construct portfolios plays a huge role in the ultimate experience of the asset owner. So today, we're going to turn convention on its head with a discussion, don't let risk eat your alpha. So why are investors generally less worried about risk? Because they haven't needed to worry about it for years. The 10-year global equity market bull run has been accompanied by extremely accommodative central bank policy, where we've seen negative rates in Japan and Europe and quantitative easing from the Fed and the ECB. We have a chart that looks at the rolling 3-year annualized volatility of the MSCI World over the last 50 years. Now, what's interesting about this chart is equity volatility has been running about one standard deviation below its long-term average for in excess of 5 years. So, despite all the noise, despite the rising populism, despite slowing global growth, equity markets have essentially been like a calm waters on a warm summer day. And quite honestly, risk control doesn't matter in that kind of environment so much. But what if volatility does actually revert to levels more consistent with what we've seen historically? If that does happen, risk measurement and control will become like a warm blanket on a cold winter's day. And critically, in that kind of market environment, effective risk controls markedly improve the predictability of the returns asset owners receive. And we've illustrated this relationship here in this graphic. On the left, you have concentrated, totally unconstrained portfolios whose outcomes will be hugely determined by macro events, given risk neutralization is so much more difficult to do. And if a single stock blows up, it has a huge impact. Then, as controls are tightened up and diversification increases, macro influences are still hugely influential, but equally so as style bias dependencies. And then lastly, as we move further to the right, outcomes are most predictable with those portfolios that have balanced style exposures and neutralized macro exposures to macro risks, and ones that also capture ESG externalities. So with that in mind, let's try to uncover the various risks that your alpha will face. Because in our experience, what asset owners find is risk measurement is hidden until it becomes a big problem. So in turn, we will explain how each of these risks you see here can surface. Let's begin with macro missteps and how it is a particularly problematic risk factor in emerging markets. Now, what we have here is a chart that outlines all the instances where a country in emerging markets has underperformed the index by more than 25% in a calendar year. As we can see, over the last 20 years or so, there have been numerous instances of major blow-ups. Most recently, it was the turn of Argentina. admitted to the index by MSCI only in May 2019 to great optimism that the country was on the right path to finally sustainably turn itself around. However, the shock election result just weeks after inclusion saw the currency plunge and the country see a US dollar return of 50% down since joining. A high price to pay for asset owners where investors were lulled by the prevailing optimism and initiated with too large a position size. But hey, with market volatility this low, active managers need to somehow differentiate themselves from the benchmark, right? And this is where investors need to be really careful. Investors must understand the active risk their managers are taking. In this low vol world, it's easy to lionize active risk to at least give the prospect of hitting those handsome active return targets. But for those big binary bets like country, currency in emerging markets, industry, capitalization, where we haven't got anything like the breadth we've got on the stock level, how sure are investors that their managers have the skill to justify the active risk they're taking there? Anyway, we're strong adherents to the fundamental law of active management by maximising our information ratio. This is the alpha of the portfolio after adjusting for the risk that we've taken. Ultimately, the question you need to be able to answer is, what will drive your future active return stream? Bottom-up stock selection or exposure to macro risk factors? Next, I want to talk about how investment metric selection can impact the return pattern of your overall multi-factor combination. Here we are comparing two very similar factors: earnings yield with backward and forward-looking earnings, and its relationship with default risk returns. Here, default risk measures the probability of a company's default by looking at its volatility and debt characteristics. Now, historically, these two factors tended to produce very similar return streams. But interestingly, over the last decade, when market volatility spikes, they now produce completely opposing return streams, as evidenced by the two major sell-offs we've experienced in the last decade. And what we show here is a table which looks at the returns that earnings yield with forward and backward-looking earnings delivered in those sell-offs in 2008 and 2011. And we can see here when markets sold off, earnings yield using backward-looking earnings delivered positive returns, and earnings yield using forward-looking earnings delivered negative returns. Nuances like these need to be understood when building a multi-factor approach. The theme of unexpected results when volatility strikes continues with its impact on risk models. Now, the use of risk models can potentially be an integral part of a multi-factor approach, but their usefulness is ultimately reliant on the past looking like the future. But what if a benign volatility regime suddenly switches? Now, let's look at an example. Here you can see the rolling 3-month volatility using daily returns of the oil price. In the 3 years to mid-2014, the volatility looks as benign as it ever has been. Then suddenly the oil price crashes and the risk model data suddenly becomes irrelevant. A strategy's position sizing that overly reliant on risk model data could then receive a nasty surprise for investors. Now let's move on to the risk of having unintended biases to certain styles in a multi-factor approach. Now, we've always felt that too much of a focus on maximising the raw returns of your approach runs the risk of introducing unintended style biases. Now, one of the reasons many systematic approaches have found the last couple of years so difficult is because of the slight biases to value they've had, which has experienced an unprecedented drawdown. Now, we take the view that focusing on multi-factor information ratios and balanced portfolio level style exposures mitigate the risks of unbalanced style bets. Lastly, ESG. Historically, a set of risks that have arguably been more prominent in emerging markets due to weaker institutional and governance structures. As such, a number of years ago, we developed a country risk model to reflect these more complex social and governance risks that simply just don't exist in any meaningful way in developed markets. We've listed some of the metrics we use to assess these risks in this graphic you see here. This data, available from organisations like the World Bank, can help us assess the more complex risks in emerging markets above and beyond what traditional models can capture. In developed markets, there is a sense that ESG risk will increasingly be priced in the future. The clearest example of this is the free cash flow yields of coal and oil and gas companies, where the market is essentially pricing just 4 more years of coal usage and around roughly a decade of oil and gas usage. How investors view the role of integrated oil and gas companies as part of energy transition to cleaner fuel will actually be one of the most interesting questions of our time. Now, more generally, we anticipate there being 3 key areas to address with risk of ESG disrupting an investor's active return stream. The first one will be on engagement, where the onus will be on active managers to take weak ESG disclosures and data directly to management and look to them to clarify where there are indeed weaknesses that need to be properly recognised and addressed. Secondly, we anticipate more active managers integrating granular ESG insights directly into their stock selection approach. And then lastly, we believe that systematic investors will need to offer asset owners the full array of tools in order to manipulate their portfolios to meet ESG preferences that each and every asset owner may have, whether it's carbon reduction, lower water usage, or more diverse boards. So to conclude, whilst it may not worry too many investors right now, the next decade will likely see risk management central to the delivery of consistent alpha. So don't be fooled by these QE-fueled benign markets of recent years, which is just really de-emphasize the importance of risk management. Because for some managers, when volatility spikes, this will dramatically reduce the predictability of their return streams, and it's crucial that an investment approach is prepared for that. Furthermore, be wary of those managers that overly rely on historical data for how they manage risk in their portfolios, because this is likely to lead to negative surprises at some point. Now, we feel that the best way to mitigate the risks of using historical data is through controlling and measuring risks from multiple perspectives. Beyond this, a balanced exposure to the key style groups, growth, value, quality and sentiment at the portfolio level helps avoid any negative return pattern surprises. And then lastly, as ESG is increasingly priced as a risk factor, systematic approaches will need to offer a variety of tools to measure and manage these risks. Thank you for listening.